All right, guys. So listen, happy Thursday. We got 18. We should have at least 20 minimum. So there's a couple people missing. So like go find them if they're your people, especially. Like don't let them like not be here because they need to hear this. Somebody asked me today, hey, how can I schedule my exam? And I said, well, you can do it yourself, or the easy button is, talk to Angela. She's our licensing specialist. And she said, well, I didn't even know I could do it myself. And so like it's again, right, there's a massive learning curve in the beginning, right? You come in and you're excited, but then you start drinking out of a fire hose, right? It's just like, oh, you get a little bit of water, but there's a whole lot that just like rushes right by your face, right? So that's why we come back and like it might feel remedial for some people every once in a while, but that's okay, right? Because some we need that every once in a while. So this is POL, right? So Primerica Online. Um, Most of the things that you're ever going to need to do when it comes to POL are only going to be in like two places. Okay. There's like right here, which is my POL. And then under my POL is all apps. Okay. Under all apps, this is like your back office, your business sort of like checkup area, pretty much anything that you need to like go find that is like what you would consider sort of like back office stuff. This is where it lives. Right? So couple of different things, especially if you're not licensed right now, things that you actually care about is right here. See where this says Daily Blast, guys? This is where you can go check Kurt, the little message that I sent you earlier that said PLPP and how much you got paid. That's where you go find it, right? I'm actually going to use you as an example so everyone can see, right? So Daily Blast, right? I'm not going to use mine. I'm gonna use Kurt's, right? Kurt was this right there, because that's the last one I did. Okay. So now I got his rep ID, his solution number, right? Because it's a solution, not a problem. So it's your solution number. And so if I clicked any of these, it would show me, right? Now, Kurt's not investment licensed, he's not life licensed, so those would not pop up, right? But cash, recruits, those are things that he would have, right? If he has done an ID theft, right? If you're not mortgage licensed, don't worry about loans. If you've done auto and home, maybe, right? PLPP or Vivint, right? Because he's unlicensed, those are the potential things that he could have right now. Okay. And so click view, and then it's going to pop up, right? Now, the first thing that pops up is cash. Now, I just wanted you guys to see this, right? Now, is Kurt licensed yet? No. So Kurt is unlicensed, right? But he's been paid. He got paid last night, right? The pay cycle happened last night. So like today, it's like in the ether, right? Tomorrow, it'll be direct deposited into Kurt's checking account. Pretty cool. Okay. He's got a recruit, right? And then down here, he's got Legal Shield, right? So PLPP, Primerica Legal Protection Program. That's PLPP. That's also Legal Shield, right? And he's also got identity theft, right? So for those of you that have been paying attention to the bonuses, right? When you get three this month and you're brand new and two are PLPP, there's a $100 bonus that's also going to come with this. I can't tell you exactly when the bonus is going to pay out, Kurt. Usually, Primerica waits until the end of the month pay cycle for all of that. And so, in reality, your bonus will probably pay like the first week of May when the RVP bonuses and everything pay when the month closes out. If I had to guess, right? Um, but you did it, right? So you've done the hard work, right? So you've got the credit for it. You've got the credit for it. So you've got technically four under your belt right now. So and if you had a Vivint referral, it would be here as well. Okay. So that's what that looks like for Daily Blast. Once you're licensed, right, and you're writing life insurance primarily, every night at 10 p.m. Eastern is when that daily blast will cycle. Okay. So that daily blast cycles, and then whatever you were supposed to get paid for will show up. And if you thought you were supposed to get paid and you didn't get paid, then there's either like some sort of like chargeback scenario that you weren't aware of, like somebody got declined, somebody canceled their policy, like stuff happens, right? But then the next morning when you wake up, right, you would come up here to recap of advanced statements because then that's going to be your your itemized list of every single thing that you've been paid for when it comes to life insurance. Okay. When it comes to life insurance. If there's something else that you were supposed to get paid for, it's going to be in one of these other like areas underneath compensation. Okay. But the biggest ones you're going to look at, guys, are daily blast around 10 p.m. Eastern. Sometimes it's early, sometimes it's late. Don't even bother on a Friday because it ain't going to happen until like 3 in the morning on Saturday. Okay. There are Saturday pay cycles that happen as well, but it's usually like one a month. Okay. So most of the time it's like Monday through Thursday. You wake up on Saturday, right? Check it. Sometimes you wake up on Sunday morning and you got paid on a Saturday cycle. That's pretty cool. When you're getting paid for a life insurance policy, when you wake up in the morning, you'll have an email, right? That do not reply email. That's one of the like coolest emails to see, right? Do not reply, advance commission, and it tells you exactly what you got paid. And then if you had some set aside to a money allocation program or money accumulation program, then it would show you that deduction as well. I'm going to talk really quick on the money accumulation program because I want you guys to know this because we're talking tonight about like having your own sort of right plan set up. And so down here under other tools, right, accumulation program. I keep saying allocation. Money accumulation program. This we call it a MAP, right? Your MAP account is where you can set up and decide what percentage of your pay commission for anything that you can get paid for would go directly into your money market account to have set aside for future funds for later. Okay, this is how we start to ensure that you're paying yourself first. Does that make sense, guys? But you have to have the money market account established first, right? So we need to meet. We need to establish that account. It's free, right? It doesn't cost you anything. Right now, it's averaging a little over 3%, which is on par with every other like money market out there because it's all based on the 10-year treasury. Okay, but I'll click this and I'll show you kind of what this looks like. Every single way that you can get paid, you can set up to have some sort of deduction, percentage wise or dollar wise, right? I just leave it on percentages because the minimum, no matter what, like it's just getting deducted, right? So every time RVP bonus hits, 20% comes off the top. I don't even see it, right? It just goes away automatically. I had some in there, right, that I can toggle on and off. Like if I want some going to a mutual fund right now, I've got everything going just into the money market because I need it liquid. Okay. Life advances, right? I've got it set at 10%. I fluctuate it up and down. Earns, right? For a while, I just had like 100% of earns going into the money market account because that's money that I'm not expecting, right? So if it shows up, cool. I just want it to go into savings. But you see how I just turned that on and then off? It's real time. So like if I had it off and I came in tonight and earned were going to pay tonight, which they should have already paid, right? I would I would turn that back on and tonight when it cycled, like I would still get paid for it, right? I would still get the credit for it. It would just go into my money market account, not into my personal checking account, right? So for those of you right now, especially that are not relying on Primerica as an income, this is how we guarantee for you and help you make sure that you are setting aside money potentially for taxes, but also just learning to pay yourself first, right? Because if you start making an extra couple thousand a month when you weren't before and you're not setting some of it aside, you need some of that rainy day money, right? But in order to do that, we have to get you set up with a money market account first. Guys, I can set that up for you in like 15 minutes, right? I always end up taking a little longer because like inevitably I end up teaching during it, but I can if we need to be quick, I can do it in like 5 minutes if need be, right? If you have all the data, I can do it quick. Okay, so it's pretty simple. But look, literally any way that you can get paid, it just keeps going, right? The PFS and Y, those are all like for New York policies, right? Prepaid legal, right? I got paid for that. I got a little override, so that straight to earns. PNC, that's property casualty, that's just home and auto, right? I send it straight in. I don't care. Like that's money that I'm not counting on. If that stuff shows up, it's just going straight to savings, right? Like that's just like freebie as far as I'm concerned, right? Variable annuity, I need to turn that guy back on, right? And so I'm going to show you guys, right? So any leader that won't show you their cash flow, right, is you should question. And so like I'm going to show you mine right now, right? So real time, right? Clicking cash. And so check it out. All of the different ways that we can get paid so far, I think, except for like mortgage, right? Now, so I got paid for a variable annuity, got paid for different securities, legal shield, life bonus, and life advances. Okay. So you see check and you see map deduction, check map deduction, check map deduction, right? So, right, practicing what we preach, guys. Like we want to make sure that we're having our own stuff set up correctly first, right? And this is a big deal, right? This is a big deal, right? Like this is a slow month so far. This is a slow month so far. I'm being completely honest, right? And so the nice thing so far is that right now we've got another week left of April production, and then the week after that is still counting for April cash. So there's 2 more weeks of April cash. And why that matters is like if you're chasing a income milestone, right? You always have like that following week for things to process through before the that rolling 12 situation happens, right? If all of that just went over your head right now, don't worry about it. We'll have another discussion on like income milestones, watches, rings, right? So when you hit 50K in a rolling 12-month period, you get your Primerica watch, right? Your Power Builder watch. Or and then when you hit 100K in your rolling 12-month period, right, you earn your Power Builder ring and you become part of the Financial Independence Council. Okay. Let's see. I think Nicole just sent me a text about like what comes up when she does her recap. Nicole, since you've just had a bonus payout from your life license, you don't really have a recap of advanced statements yet. Since you haven't had like an actual uh, like commission payout, right? Because you didn't get a do not reply advance commission email on your bonus either, right? So, and if you're getting that weird, what does this say? If you're getting some sort of like weird like IBM Cognos or some sort of error thing, you have some sort of like you need to close all of your browsers and then open them back up. Is really what's going on there. Okay. Last thing we're going to do on POL really fast, guys, is we're going to talk turbo apps. Okay. And I'm going to show you 2 ways to get into turbo apps. You can do anything that I'm showing you right now also on your phone, right? You can pull up a browser on your phone and you can navigate. You might need to zoom a little bit, but you can do it, right? I do it every morning when I'm walking my dogs. I'm checking on certain things, right? But if you're with somebody and you're trying to like submit some business from your phone, here's what it would look like from your app. Okay. Now, if it's slightly different if you're appointed and licensed versus you're brand new and unappointed still. Okay. So if you're brand new, your turbo apps right here are going to be down here underneath tools. Okay. If you're appointed and you're licensed, your turbo apps just live on top level. Okay. So the reason I'm showing you this is because you can submit policies from your phone. I could do an investment from my phone. I could submit a legal shield from my phone, identity theft from my phone, right? It's all right. I could do a policy change from my phone for clients, right? You have the ability to be mobile, and the same thing on like an iPad or a tablet because you can always just go to a browser, right? So this is all here. Auto and home referral. If you haven't gone in and set up your Refer Secure Answer Financial like profile yet, you should do that. It logged me out. I, I'm not gonna like I don't really want to go look on that right now, but normally it leaves you logged in and it would pull up my rep ID and everything and it's already there, right? So go do that if you haven't. But then the other way to get to Turbo Apps from POL is up here at the top, right? All these blue words are hyperlinks. Okay. So if you ever wonder like, hey, where's my Primerica mailbox? Well, come over here at the top where it says mail and boom, Primerica mail. Okay. If you want the instructions on how to get your Primerica mail onto your phone, click that and you'll get a PDF for Primerica instructions for both iPhone and Android. Okay. It's there. You can get that set up. But Turbo Apps right here, okay, it'll look a little different, but it's the same stuff. All right. It'll look different, but it's the same. So quote, like quick quote, that's for obviously giving a quote for life insurance. FNA is the financial needs analysis button. That's the full, like full blown, the big daddy, right? IBA, right? So business application. You can recruit somebody. You do not have to be licensed to recruit somebody, right? I would actually prefer that you do your first recruiting independently before you're licensed because it sets you up to do client appointments. You get more comfortable on Zoom. You just get some of those bugs worked out. Okay, life, policy change, investments, basic illustration. Some of these things, if you're not licensed, won't work, so don't even stress, right? Different calculators and then other products on this Turbo app version. That's where your auto and home, legal shield, and identity theft live. Okay. Questions on any of that? And I know I've been going fast. So like this is like legitimately your time to ask questions, guys, if you have them. Anything anything that you guys want me to go back over, you need to see again. Okay. For those of you that are newly licensed, i.e. Serena and Nicole, if you're here and you're clicking this and it's like not working for some reason, sometimes it'll go straight into the quote, sometimes it won't, right? So it'll bring you here. This one is a generic quote, right? All you need is somebody's age and gender and whether they're nicotine or not, and then you can start playing around. Okay. Power term is no medical, precision is a medical. Different things will pop up, right? It'll show you what your limitations are. Like Nicole, if you're trying to do a policy for somebody who's 70, right? And they just want like 25,000, you can't do a precision term policy for below 50,000. So you would have to do power term for them, right? So you can look at it and kind of see, but it's gonna be expensive, right? So 170 bucks if they just want like a $25,000 like, hey, this is like, the ish is hitting the fan, just want to have something, right? Save them 60 bucks a month. It's something there, but the smallest you can do is 15,000. Okay. Smallest you can do is 15,000. Now, if somebody's super young, guys, the smallest policy that you can do is 15 bucks a month, right? And so if you get into a situation where you're trying to get it really, really small, it'll come back like that, and the system won't even let you submit it. Okay. So this would probably have to be like 150,000. There you go. Does that make sense? Okay. Now remember too, banding levels, right? Banding levels, 150. Oh, it didn't pop up. Weird. Okay, there we go. So if you get really, really close to a banding level, the system is smart and it'll pop up and it'll say, hey, Mr. Agent, Mrs. Agent, consider going to 150, consider going to 250, consider going to 500 or 750 plus. You may end up like unlocking a bulk discount for your client. I'm going to try to make it a little more extreme. Okay. So 140,000 and it's 46 bucks, right? If I get to 150, it got cheaper. So you give the client more, you save them money. Do you think you'd have a better odds of getting that one to go through? If they were asking for a specific amount and you're able to give them more in coverage and save them money, do you think it would go through faster for them? Are they more likely to say yes? Yeah, of course, right? Everybody loves a deal. Everybody loves a deal. All right. So just some basic stuff, guys. And then just so you know, like this is where we never go to the life tab, right? So like Nicole, Serena, if you guys are playing around and you're like, oh, I want to do a policy. And you're like, well, the thing that makes the most sense is I go to Turbo Apps, right? And then I hit life application. Well, that's would kind of make the most sense, but don't do that because you're gonna have to go through the whole process almost of that first, like all of the information, right? You're gonna have to get all this information from the client before you can even get to numbers. Start with the quick quote and then hit apply now and then go through the application. All right, guys. All right. Any questions now? Going once, going twice. Nothing. Is there anything in the chat? Have I been like neglecting the chat? Okay. Everybody's just saying yes and got it. Sweet. Okay. Good, 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 good. All right. So listen, this is that's Evan's vaccine information. Don't look at that. That's his stuff for West Point. All right. So there's a 6-page sales presentation that Primerica uses. I have taken it and tweaked it a little bit. I sort of Frankensteined one into one that makes more sense for what we generally do, right? And so it's still the blue page. No changes here. I didn't tweak any of the actual like data. I just did like what was that 3 card Monty, right? And just moved some of the pages like in and out with a PDF editor. So we've still got the blue page. Then we've got the like kaleidoscope or like pinwheel of products, like everything that you can give like that Primerica overview to somebody with. Rule of 72 and debt stacking, right? So debt stacking, rule of 72, pretty important. Okay. Cash value versus buy, term, and invest. We're going to talk about this a little bit tonight. Decreasing responsibility. Now, this is the decreasing responsibility chart, but I juiced it up a little bit, right? I added some XY axis because it's things that I used to say, but I wanted people to be able to see it because people don't really believe what they hear. They believe what they see. Okay. And so we'll talk about this a little bit, but this is the theory of decreasing responsibility, right? So assets, right, as they go up, right? When you're young, right? Let's be honest, guys, when we're young, our assets are pretty low, right? Our assets are pretty low when we're young, but our liability is pretty high. Okay. But as we get older, the model flips, right? As we get older, now our assets are way up here and our liability should be way down here. Okay. You're not working anymore. We're not really replacing an income at that point. Your mortgage should be paid off or close to it. right? Your kids are grown and out of the house. Well, if all of the stuff that you were worried about protecting over here with life insurance has changed, well, why do you need that much life insurance anymore when you're in your late 70s, mid to late 70s? Well, like, do you need that much anymore? Well, we would argue no, right? Like as life falls off, as your liabilities fall off, right? Your life insurance should not need to be that high. You don't need to pay for it for life. And so this is a great question that you can ask people, guys, during client appointments. What life insurance company do you know that would teach someone how to eliminate the need for life insurance? Because if you're doing it right, if we're buying term and investing, my job is really to get you out of the need for life insurance. If we're doing the complete job, that's really our goal, right? By the time you retire, you should be self-insured. That's our true goal, guys. Okay. So, and then again, these are some things that I've built in, right? Three accounts that you need. You need an emergency fund, right? The Dave Ramsey model says maybe 1,000, 2,000 in cash. That's something that you can access immediately, keep you from having to put it on a credit card, right? You need to, like, your washer, like, blows up on you. You need to replace some tires, right? It's just something that you can access immediately and then you can replenish. Okay. Short-term account, this is your money market account. This is where we're working to get 3 to 6 months worth of cash and income set aside for like actual emergency. You get laid off unexpectedly and you can't get back to work right away, right? For most people, right? That's where we're like, oh, if I don't have that, how do I pay the bills? How do I keep the lights on? Right? So that's your short-term account. We would put this money in a money market account. That way you can access the money. It's in, it's out. There's no penalty, but it's still earning and it's still getting you more than what your checking account is giving you guys. Right? Everybody do me a favor. Everybody probably has like a banking app on their phone. Yeah. Right? Do me a favor, go to your bank app and look at your statement from last or from April. Go back to the beginning of April and you should see like an interest payment. Put in the Zoom chat, tell me what that interest payment is, please. Right? I looked at mine earlier today. I think it was 3 cents on my like checking interest account, right? Anybody there yet? 3 cents, 2 cents, great. Okay. 5 cents, April. Okay, pretty good. Cents in a pattern, right? 3 cents. Somewhere between a penny and 3 to 5 cents, right? And so now, if I had to guess, guys, 3 cents, 3 cents, 2 cents, 5 cents. For those of you that said 3 to 5 cents, you've probably got somewhere between 3 and 5 grand in that account on average, right? Pretty close. Now, if you had that same money in a money market account right now, it's getting it's 3.17 earlier today. So let's just say the same 3 grand, right? Times 3.17%. That's what it would be earning for the year, right? 95 bucks for the year because that's an annual rate, but your money compounds monthly. So let's figure out monthly, right? That same money sitting in a money market account, guys, would have earned you almost $8. Now listen, you ain't gonna retire on $8. But if we're comparing 3 cents to $8, Matt, which one do you want? $8, right? If it's pennies or dollars, man, I'm taking dollars all day, right? Current APY, Nicole, exactly 0.1%. 0.1%, right? Some banks are even worse. B of A is atrocious. It's 0.01%. But the national average is about 0.1%. So the way to think about that, right? If you had a penny and you cut a penny in 10 pieces, that's 0.1%. It's a tenth of a penny. Is really the way to think about it. Okay. And so the reason we want you guys to have your liquid cash, your free money, like that's just kind of sitting around, like just in case, right? We're giving the way Dave Ramsey talks about it, right? You're giving every dollar a job, right? You're giving every dollar a purpose. If it's not paying off a bill because it's sitting over here, like call it dry powder, right? Just in case, right? Well, it needs to be outpacing inflation or at least pacing with inflation. Right now, the only way you're going to get that and have your money liquid is either in a money market account or some version of a high yield savings. Okay. The beauty of ours when we do it for clients is that you can open that account, Kurt, with 25 bucks and 25 bucks a month. If you went to another bank, most bank minimums or even other like financial institution minimums on opening a money market account are somewhere between two and $5,000. If you're not bringing two to $5,000 to the table, they're not even talking to you about opening that account. And then on top of that, they have limits on what sort of like promotional rates they're going to pay you back at. With us, no limit. You put you put 500 grand in there, all 500 grand is earning your 3%. No limit. No limit. Okay. Just kind of moving on some more. I'm just breaking down what's in this document. Now, I'll tell you right now, this document, right? Just like the way we talked about Teachable the other day being a red line hierarchy sort of thing, this document that I've built is our team only thing. I have not shown this to Andy yet. I have not floated it out there. It's one of those things where like if you're going to change something, you test it at a small level and then you roll it out to everybody else. Okay. So there's nothing in here that is not a Primerica product other than this. This VGLI table is the only thing that is in here that is not a Primerica product. And the only reason that I included this is because our team specifically has a very, very heavy military client population. And part of the education process, especially for me, with those agents or with those clients, is them understanding what VGLI is. Yes, Kurt, I will share this out in the Telegram. That way everybody has access to it. That way you can click it, download it, have it on your phone, have it on your desktop. It'll be everywhere. Okay. For those of you that know military people, right? I'll explain this to you really fast just so you understand. 500,000 is the like average coverage right now for military. That's the max that you can have through the group life insurance plan. When you separate from the military, retire, either way, you have access to what we call veterans group life insurance. And if you're pretty young, it's pretty cheap. It's not bad, right? And the nice thing about it is that you can't be declined if you accept it within the first year. There is no application, there is no medical questions, right? You just get it. But as you get older, right? Like for me, I'm 44, I'm going to be 45, so mine's going to go up. Right now it's only 25 bucks, but I don't know what the rate's going to be next year, right? So you're always at the mercy of a rate change. And then every year, every 5 years, excuse me, guaranteed your rate is going to increase, right? Now, 40 to 45, not that big of a jump, right? 49 to 50, 50 bucks a month, that's pretty significant. 50 to 55, that's $100 jump. This one's the biggie, right? You start getting into these guys and you start going, I'm not paying for life insurance anymore. The craziest thing, guys, right? If I met somebody even at 40 right now, I could lock them in with a term that would take them all the way to 75. If they're 42 even and retiring like when I did, right? And I took them all the way to 77, that'd be a 35-year term and the price would never change. They might pay a little more in the first couple of years, but in the out years, game over, right? Because think about it. If you're a veteran and you're in your late 60s, are you really going to pay $700 a month for your life insurance? Or are you just going to say, I'm going to let that go? You're probably going to let it go, right? You're probably going to let it go. That's where having a level term policy, guys, is so powerful. It's so powerful. All right. So back to us kind of having our own like plans in place. Okay. So if you have some debt that you have been struggling with and haven't figured out how to get rid of, and you're just sort of like toiling with it, guys, sit down, grab one of us, and let us help you build your debt stack inside of your financial needs analysis, right? If you're licensed, go do it yourself. Go play around with it. You can't break it, right? Go into the F&A and play around with some stuff. right? I'm recording, so if I pull it up, it's gonna like the whole YouTube will like crash because it'll be like showing personal information. So I'm not gonna do that right now. But go to the F&A. The two tabs that are really the most important are the debt consolidation tab. That's where you actually put in your bills for like your debts, right? You just need your minimum payments, your balance, that sort of thing. And then the other one is your actual like budget tab, right? That's where you put in like your utility bills, your every other bill, and then at the like the grand total at the end, it's going to show you like how much money you have in, how much you say is going out. And every time I have ever done one for somebody, guys, there's always more money left at the end of the month than they say there is. It's always green. It's always green. Can you imagine why it's always green and there's always more money the first time we put everything in? What do you think? You can unmute yourself or put it in the Zoom chat. I don't care. Why do you think there's always more money? Anybody?
As they don't realize how much they actually could potentially have, and instead of just spending it on useless stuff.
Because they know how much they're getting paid. Angela, you're exactly right. They know how much they're getting paid, but they have no idea what they're actually spending. Because what they're giving me is the bills. And what they're not taking care of, like taking account, is Uber Eats, Amazon, just drive through, Starbucks, Dunkin', Tim Hortons, you name it, right? Like those things are not getting like accounted for. And so what I would challenge you guys to do, and I'll bring it up and I'll stop a recording here in a minute. But what I would challenge you to do is take a look, right? Take a look at your checking account, take a look at your card statement, whatever, right? And go through and highlight all of the things that you didn't even realize you were spending money on. And this is not about becoming some sort of like Spartan stoic, like live in a cardboard box and Scrooge McDuck and hoard every penny. That's not what this is about. But this is about like understanding where your money is going. Okay. There's a funny saying, right? Like money is a fickle mistress. And if you don't pay attention to her, she will leave you. She will leave you, right? You have to pay attention to your money. You have to understand. Okay. So let's just talk about debt stacking really, really fast, because this is an important part of what we do. It's one of the two main things that we do. We buy term and invest, right? That's one thing. And the other thing that we do is debt stacking for people because that's how they're going to get free. These are all someone's bills, right? They're actual just like balances for like debt, right? Got a couple of cards, personal loan, it could be a car loan, right? You name it, right? We would name everything individually. There's no money extra going into this client's budget to pay bills. Okay. When we set them in, guys, all of these payments are set at the minimum payment to keep everything current. And then once we're done with that and we're done with looking at all of the other like household bills and everything, we figure out how much is left. And if there's something left, we will add it here. Okay. And then once credit card one is paid off, we debt stack down to the next bill. But without a plan, right? Guys, without a plan, when most people pay off a bill, what do you think they're going to do with that $180? Put in the Zoom chat. What do you think they would do? What do most people do? Heck, what do you do? Right? And just be honest, right? There's yeah, go to Target. I love it. Jen, I mean, she's like, boom, right? I'm gonna go into Target, I'm gonna grab my Starbucks, I'm gonna stroll around, I'm gonna like up and down the aisles, I'm gonna find some stuff. Yeah, I'm gonna hit me some Amazon, right? It's too easy. It's too easy. But if you have a plan, Jen, like if you have a plan, you might call me and say, "Hey, no, I paid off card one. I'm so excited." Woo! Right? And I'll say, "Hey, great, let's pull that up really quick. Hey, listen, we're gonna take that 180 and we're gonna roll it down to the next one." You might say, "Hey, look, I need some fluff over here." I'm like I'll say, "Cool, look, we'll just roll 90. We're still gonna accelerate the thing. We gotta stay on track. We gotta have a plan." Okay? Because if you don't know where you're going, can you get there? You can't. And so, guys, it's the same thing that we ask clients and agents, right? Like you need a GPS or a blueprint for your money because you don't have one. Most people don't, right? And then boom, look, we pay off card two. Now we start accelerating that loan. And all we're doing is moving this down. There's no extra money. But look what still happens no matter what. Look what still happens, guys. You're out of debt almost 15 years faster and save $112,000 in interest. Well, most people will say, well, yeah, I mean, most of that interest is coming from your mortgage. I don't care where it came from. You're out of debt 15 years sooner and saved over 100 grand. I don't care where it came from. Because now what do we have extra every month? Now there's $2,500 that you used to be paying bills with that now we're not. And right, you can start paying that money to yourself and start investing it into a mutual fund, right? Look at this. $2,500 a month at a 9% rate of return until 65. I don't know what, like there's probably some like fine print somewhere, right? But that's probably they probably like paid off their debt at like 35 and there's 30 years of investing. 2 million bucks. Guys, like that's a powerful narrative, right? Like, man, Matt, how long have you been trying to get out of this debt? A long time. Has anyone ever tried to like give you a plan or like help you get out of that before? No. Well, look, dude, that's one of the main things that we actually do for clients. It's part of that like GPS, that roadmap for your money. It's that financial needs analysis. And the best part, dude, is we do it all for free. Matt, everything I'm ever going to do for you is going to be free. You are never going to pay me, right? I see your face, right? Most people say BS, bro. What's the catch, right? Nothing's free. And I say, no, really, it's free, right? The only thing I would ever ask in return, Matt, is if it makes sense, do it. And if it makes sense, I would probably ask you for 10 names of people that you think would benefit from this. I mean, Matt, let's be honest. Can you think of like 5 to 10 people right now that need to hear this and would benefit from hearing this? Perfect, dude. Would you do me a favor? Would you write those down and like text me their names and numbers? Even better, if you'd be willing to go like the next step, just make an introduction and link us up on a text message. Would you be open to that? How hard was that to ask for that referral, guys? If I'm helping Matt and he's happy, I just asked for referrals and I got 10 new potential clients. It's up to me to close them, but he just gave me 10 new clients. But you got to ask. You got to ask, right? That's that's the power of what we do. But listen, if you've never sat through your own kitchen table appointment, you've never called Answer Financial, you've never let me explain the rule of 72 to you and go through a mobile F&A and see what that actually looks like. If you've never done that, we need to, right? We need to go start to finish on that thing. And if you're sitting back and you feel like you're a little bit older and you're like, that's not worth it, right? It is. It is. I sat down with Ellen and her husband last night. We didn't go through the full like shebang of everything, but I answered a bunch of questions for them that they were getting bad information on, right? He thought he wasn't going to be able to keep working and pull Social Security. I said, well, let's just Google it. I said, well, based on your birthday, you can start pulling your full retirement age Social Security at 67 and keep working. And there's no limit. He said, what? I thought I had to like throttle everything back. I'm like, not according to the IRS. So I don't know where you got that other information, but this is real. He's like, well, that gives me like, guy, like at the end of the day, it gave him hope, right? I didn't sell him anything. He didn't need anything. And that's what you got to kind of get out of your brain, right? Like, oh, I don't want to bug them. Like they're gonna feel like I'm trying to sell them something. No, we're not. Guys, I'm not selling you anything unless I think you need it. I'm not even offering it to you in most cases unless I think you need it. Guys, I've actually gone through appointments and not offered somebody something, and I got like approached and like, well, hey, aren't you going to sell me something? I'm like, I mean, I could. I didn't really think you needed it. He said, well, I actually kind of want some of that life insurance. That sounds really good. I said, great, let's do it. We show, we don't sell. I have to train you to be good at sales. But that's not where this leads from, right? Like that's not where that's not where your heart comes from when you sit down on an appointment. I'm here to educate. I want to make you feel comfortable, right? And if we don't close on the first appointment, okay, right? But I guarantee you, like Ellen's husband, he was walking away from that going, I might need to jump on this. I might need to start selling this because he was fired up, right? And so was she because she had already kind of got that crusade bug about buy, term, and invest and why cash value is not great for people, right? And that's what I'm going to do here in a second. I'm going to teach you why cash value is really the enemy in most situations, right? There are situations where it's actually, not the worst thing on the planet, right? But for most people, a cash value policy is a bait and switch. It's a bait and switch, right? So let me pull up this out because I want you to see like what's in the document first, right? So cash value versus buy term and invest. It's right here. Okay. And like if you go to the fine print, right? The client's 30 years old. They get a standard rating, right? So four for women, six for man. It's or they're 35, sorry. They're 35 years old. It's a 30-year term that we're changing them to, right back then, and they got a standard rating. And the compounding is at 9%. It's not any sort of like crazy rate, right? That's what's in the fine print. Okay. They started at 200,000 each in a whole life policy, paying $315 a month. We doubled their coverage. Now they have $400,000 in a term for 30 years, right? Their price went way down, and we took the exact same money that they were spending on the cash value policy. They were already spending it. We're not worried about saving it. We're going to invest it. And at a 9% rate of return, that $200 a month for 30 years turns into almost 400 grand, right? Now, for fun, how old would John and Mary be when their cash value policies reached $400,000 in cash total, right? 200 each. How old would they be? Does anybody know? Put in Zoom chat. How old would they be? Just generally, right? 100. There are different provisions. Some reach it later, right? But on average, most cash value policies, the cash value reaches the death benefit at age 100. I have seen ones where that's 120. I don't know who's making it to 120, but on average, guys, it's 100. Okay. So if you've got 65, if you've got almost 400 grand at 65, and this is in a Roth IRA, it's tax free. You can take it all right now, touch it, roll around in it like Scrooge McDuck if you really felt like it, right? Or, right, you won't even have 400 grand until you're 100 years old. Who wants to wait 35 years? I sure the hell don't, right? So there's no mathematical situation where buy term and invest loses to a cash value policy. There's not. There's zero. There's no chance in HE double hockey sticks. The math just doesn't math. Here's why. Let me show you. Right? Because one of the main arguments with people with a whole life policy as well, when I get to 65 or 70, I stop paying. I say, okay. And they say, well, but my cash value keeps growing and it keeps accumulating. Okay. Right? But if you want any of that cash, guys, what do you have to do? How do you get the money? Is it just your money or do you have to borrow the money? You have to take a loan. And when you take a loan from a bank or anywhere, what do you have to do with it? You have to pay it back with interest. Now, again, the other argument is, yeah, but I'm paying myself back that interest. Okay, well, if you had to take the money in the first place, what are the odds that you have the money to pay it back with? This is where people get screwed. Because if you don't pay back the loan and then you die, who gets paid back first? Your family or the insurance company? The insurance company. It's a debt. You owe them back first, right? So watch this. Let's just say at 65, our John and Mary client did not, right? They didn't touch the money. They didn't need it. There was 370, I don't know, $5,000 in there, right? And they're going to stop putting money into the investment, just like we would stop paying on the whole life policy, right? Because if the argument is we're not going to touch it, right? On the whole life policy, we're not going to take any loans, right? We're going to stop investing over here. And I will put that money into something extremely conservative. Hell, guys, I'll put it into a friggin' fixed indexed annuity and guarantee the client 6% if we're not going to touch it. I don't care. Look how much it becomes. For the next 35 years, if we ain't going to touch it and we're also not going to put any money into it, it's going to become $3 million. Now, look, I'm pretty good at this, but you don't have to be good at sales to ask someone if they would rather have 400 grand at 100 years old or 3 million at 100 years old. If the timeline's the same, I want more, period. And guess what? So do your beneficiaries, because that's what it's all about anyway, right? If we're talking about life insurance, that's what it's all about. It's not for you, Trey Lynn, it's for them, right? That's what it's for. It's not for you. It's protection. It's insurance protection. I mean, it's income protection. That's what life insurance really is, right? And so when we start talking about the investment side, guys, like this, look, you can't tell me that someone could look at this and say they would rather have 400 grand than 3 million. Hell, I'll even say like 4%. I don't care. It's still 1.5 million. It doesn't lose. Hell, I could put the money in a friggin' money market account at 3% and it's still 1 million. It doesn't lose. There's no scenario where the whole life policy wins. Now, here's the really gross part, right? And some of you may know this, some of you may not because you're relatively new. Here's the really gross part. And here's the way I want you to think about cash value. Cash value is a product where you actually pay for two things, but you're only ever going to get one. Okay. And so here's your cash value box, right? And then we're going to split it. And on one side, you're going to have insurance. Okay. And on the other side, you're going to have cash. Oh, I can't write today, but you guys get it. Okay. This side's cash, right? And this side's insurance. Let's just say this is a $500,000 policy. Okay. If you die, and let's just say you've been paying on it for, I don't know, 15 years, right? And there's 125,000 in cash in here, right? Kurt, if you die, and this is the policy that you have, does your family want a 500,000 or do they want 125,000? I know it's a stupid question, right? But
Half.
just humor me. They want more, right? They want more money, right? So when they take this, because you know they will, who keeps this? Does that seem fair? Isn't that your money? It was, right? It was. So when you think about it, the longer that you keep a cash value policy, the less life insurance you're actually getting as a death benefit. Let's roll the scenario forward a little bit longer, right? Let's say instead of 125, let's say now it's 250,000. That's not chump change, but it's still less than a 500,000. So if you leave 250,000 on the table, Kurt, right? And they take a 500,000, you really got 250,000 in life insurance and you're 250,000 in cash back, if you want to think about it that way. But at the end of the day, there was still 750 on the table. So the longer you keep a cash value policy, the less life insurance you're actually getting back in a death benefit when you die. It's kind of gross. Do you guys see what I'm saying now? When you pay for two things, but you only ever get one, the only way you'll get both is in a specific scenario with what's called an option B rider in the policy. And in most cash value policies, it doesn't exist. It's only in IULs or certain variable annuity products, variable life insurance products, excuse me. That's it. But now you're paying a premium on top of the premium to be able to have the benefit of getting both back when if you just bought a term policy for a long time and invested, you'd be so far ahead of the game, it's not even funny. Because here's the real dirty part, right? This is like insurance, like master's degree level. Kurt, when you go buy a whole life policy, right? You go buy a $500,000 policy, you pay them like $500 a month, because that's about what it's going to be. internally, without you knowing, the insurance company internally buys a term policy on you because they're hedging risk. Because now they have a $500,000 risk that they have to take care of, and you've only paid them $500. Does that make sense? Right? So they took your $500, they put a term policy on you, short, right? 10 years maybe, right? Because that's the cheapest thing they can do. They put a term policy on you to cover the risk, but you don't know about that. It's an internal process. Now their risk is hedged. They take the rest of your money, probably $450, and they go invest it in the market. Because for the first 2 years of your policy, there's going to be zero cash in the cash value. So they're going to take your 12 grand, they're going to go invest it, they're going to put a term policy on you to hedge the risk. Did they just buy term and invest? Holy moly. So guys, if those companies are going to buy term and invest on you on our clients when they go buy a whole life policy, shouldn't we just cut them out? Save the client a boatload of money, get them a very cheap term policy for what they're getting, go invest the rest of that money, and now they've got both. And the reason that we're able to do that, and the reason that we can compete against that whole life product, guys, is because we offer some of the longest level term policies in the industry. 35 years. That's unheard of. There's like one other company, and it's part of like the Ramsey Financial Solution, right? That offers terms that are that long. That's why we are designed to destroy whole life. Because the other thing that you'll run into with people is, well, when a term policy, like I had a buddy and his term policy ran out and he had to, reapply and price went up and his only option was to convert to whole life and blah, blah, blah. It's like, hey man, listen, I get it. That's most companies. At the end of our term, can I tell you the way it works with us? Right? Get a yes, right? Would it be okay if I told you how it worked with our term policies? Awesome. Listen, at the end of our term, if you decide that you still need coverage or you still want coverage, because you shouldn't need it, right? When you get there, if you still want it, you can't be declined. Kurt, if you decide in 10 years that you want to renew that policy, it's going to be more expensive because you're going to be 10 years older. But that's the only reason. And in reality, if you're okay paying that like 50 or $60 a month, whatever you've been paying, we would just convert your policy to decreasing term to 100, and your price will stay the same. Your cost or your insurance will just go down over time. Okay, so that you have conversion options, right? And so what that looks like, guys, is you've been paying this amount. Let's just say your clients are paying $100 a month, right? And then they get here and their term is up, right? Well, now their term is up, they have options. They can renew it, right? So they can renew. The price will go up. I promise you the price is going to go up. I don't know what it's going to be until your policy issues and it's in your policy. Because if you have a client that comes back with a preferred health rating, when they go to renew that policy at 70 or 75 or 80, did you know they keep the preferred health rating? It doesn't matter what's going on in their health. They could have like 99 different versions of cancer, but they keep the preferred health rating. Isn't that crazy? What other company can you think of that would do that? That's nuts, right? So you can renew it, but the price is going to go up, right? Or you can do what we call decreasing term to 100, and now your price stays the same, Kurt, but this is your insurance, right? This cool little line right here, this is your insurance. I don't know what it's going to be when we convert it, right? Maybe you go from like a quarter million to like 50,000. I don't know, right? And then every year as you get older, your price stays the same, but your insurance just goes down. At some point, it's not going to make sense to pay for it anymore. But if you want it, you have options. And Kurt, I don't know about you, and I don't know what I'm going to want 30 years from now, but I sleep very well at night knowing that God forbid my term's about to be up and I'm on my like deathbed and it's over, that if I really, really wanted to, I can renew that joker and it's just going to be a couple $100 extra a month because I probably ain't going to be around that much longer. And my family's not going to care about paying a few $100 if they're getting a half a million or a couple million back. Does that make sense? That's why we have options for you. You can renew it if you want, you can convert it if you want, or you could just say, hey, look, dude, I got like $95 billion sitting around. I don't need your stupid like $250,000 life insurance policy. I'm self-insured. And that's what we ultimately truly want because I don't want you paying for life insurance forever. I just want you to have it when you really, really need it. When you're young, when you have kids, when you have a spouse, when you have an income to replace. when you have liabilities that exceed your assets, or when you just want to leave something behind. You want to just have some sort of a like small estate left behind or some sort of estate, right? You don't have to have liability to have a life insurance policy. Makes the most sense, right? It's the most responsible thing, but you don't have to. Guys, I have single clients that have life insurance policies because you know why? They have nieces, they have nephews, they have siblings, they have parents. You don't have to have a spouse. You don't have to have kids, right? Your beneficiary can be anybody you want, quite literally. And it's revocable. You can change it whenever you feel like it. Clients can control that in the app, right? So guys, I hope you learned something tonight, right? I kind of wanted to just do like a little bit of everything, but what I really wanted to focus on was the primary things that we do, right? Buy, term, and invest. We're on a crusade. Like the company was built to eradicate whole life cash value life insurance, and hopefully you understand why, because it's a bad product for most people, right? Guys, most people that need life insurance, they just need a term policy that's really, really good that isn't going to change price on them, that's affordable, that is going to protect them and is going to be able to provide multiple years of income to replace what they've got going on. That's the most important thing. That's the most important. That's why it's the foundation for the financial house, right? So buy term and invest, right? The invest side, guys, if we have not sat down yet and talked about a money market account opening, a Roth IRA, if you're young and still working, even if you're a little bit older and still working, we should still talk about that. As long as you hold it for 5 years, your Roth IRA money that you withdraw later will be tax-free. Everything that you put in, you already pay tax on. Everything that it grows and becomes when you go to pull that money out will be tax-free as long as you hold it for 5 years. Okay. Like my dad's 60, 66 when I started the business and when I got an investment license. It didn't make any sense for him to open a Roth IRA because he wasn't going to hold it that long. Right. So we just rolled over his money and did some other stuff with it. Okay. And so that's why like every client is different, right? I'm not sitting down with every client, guys, and opening a money market account, a Roth IRA, and doing all this stuff. For most of them, yeah, it makes the most sense. It's part of like the basic plan that we would do for people, right? When you look at life insurance, that's the foundation. Because God forbid I lose you like 6 months from now, right? That $100 a month is is not gonna be worth anything, right? It's gonna be like 600 bucks. Angela asked me to share her dad's story. Her dad's gonna be 73. He's the only client that I've ever put into this one type of annuity so far, because when he turns 73, he has to take required minimum distributions out of his 401k that he has from his like job from forever ago, right? And so the reason that I put him into this product is because it has what's called a estate lock rider. The beauty of estate lock is that he can take as much money as he wants out of that annuity once he starts like taking his withdrawals next year. And as long as there's a dollar left in it when he dies, because he's going to, right? We're all going to, right? When he dies, as long as there's a dollar left in it, his beneficiary, his wife, right, is going to get back every single dollar that he opened that account with. Guys, that's baller, right? That's freedom. He doesn't need the money, right? He was planning on leaving it anyway. But I'm saying, look, you can use the money and you're still going to get to leave it. That's the beauty of it. It's costing him like 1.5% a year. Who cares? It's still tracking the market. It's still growing. That's 150 some odd thousand dollars he could pull out and go do whatever the hell he wants with. And if it gets down too low, he could put money back in. It's the greatest thing out there like in that situation, right? It's not appropriate for every client. You need to be of a certain age for it to make the most sense. But that's why we have different products for different clients, guys. And it's crazy. And I'll tell you right now, as soon as my dad's other investment matures, I'm moving it into that kind of product because I want him to be able to enjoy that money. He's worked his butt off. And I don't want him worrying about just living off of his Social Security and whatever else he's got kind of set aside. I want him to enjoy that. And if he knows at the end of it that me and his grandkids are going to get back everything that he has right now in that 401k, he can go live it up. He can live it up because it's all coming back, right? The age requirement for a state lock gen is well, we can talk about that. It's generally um you're generally looking in like mid 60s, and the cap is 75. If someone is 76 or older, it's we cannot initiate and open a new product for them with that. Okay. We can, if you want to talk about it though, just shoot me a text. We can set up some time. We can talk tomorrow. If there's something that you want to like play around with, we can talk about it. Okay. All right, guys, I love you. Like I was sorry, I was a little fired up tonight. I know it's a little loud, but like when I start get going on this stuff, like this is truly like passion stuff for me. Like this is the crusade, right? Like this is what we got to get out in front and show people. And this is truly what the business is all about, guys. And if you treat it like a business, it'll pay you like a business, right? That's the thing to always remember. So look, I'm going to throw this presentation and I'm also going to throw my calendar out in the Telegram. If we haven't set up a money market account yet, please jump on my calendar. Let's do that tomorrow, right? Because you need it to have for your map for your money accumulation program. If we haven't talked about like your actual like plan and and you haven't sat through a full KT yet, or maybe it's just been a minute, right? Let's link back up. Let's go over some things. Um, but please like leave the time for somebody who's like not had a chance to like link up yet. My time tomorrow is kind of limited. I'm not available after I think 4:30 or 5 o'clock. But I have a little bit of time left on Saturday as well. But yeah, Jen, let's link up and we'll talk about that and we can kind of go over some options for you. Okay. All right, guys. I'll get this recording out as well. Have a good night. Matt, sounds good, man. Let's do it. Actually, just wait. I will sit with you and you can open your own. Deal? Yeah. Duh. But I will walk you through it. Yes. And you don't split me. I'll walk you through it. All right. Bye, guys.